Before you ask which stock to buy, answer a harder question. Where exactly is your return supposed to come from? If you cannot answer that, you are not following a repeatable investment process. You are relying on luck. Every change in a company's market value can ultimately be traced back to two variables: the company's earnings and the valuation the market assigns to those earnings. Understanding those two variables can help you decide what kind of investor you want to become and what you can rely on to survive in the market over the long term. A stock investor's total return includes changes in the share price and dividends. For this discussion, let us set dividends aside and focus on the share price. At the per-share level, share price equals the price-to-earnings multiple multiplied by earnings per share. To see the entire business more clearly, multiply both sides by the number of shares outstanding. The equation becomes market capitalization equals the price-to-earnings multiple multiplied by net income. The share count still matters because it determines how much of the business each share represents. But this company-wide equation makes the central idea easier to see. A company's market value changes for two reasons. Its net income changes, or the valuation multiple assigned to that income changes. If we place three possible directions for net income, up, flat, and down, against the same three directions for the valuation multiple, we get a simple 3x3 chart. That chart forces us to answer two important questions. Where do stock market returns come from? And which part of those returns am I trying to capture? Boxes 1, 2, and 4 are the clearest positive scenarios. Box 1 is the most attractive. Net income rises, and the market also assigns the company a higher valuation multiple. Earnings growth and multiple expansion work together. This is traditionally known as the Davis double play. Here is a simple example. Suppose a company earns $1 billion and trades at 10 times earnings. Its market value is $10 billion. A few years later, net income doubles to $2 billion. At the same time, the valuation multiple expands from 10 to 20. The company's market value rises from $10 billion to $40 billion. That fourfold increase came from two separate doublings, one in earnings and one in the valuation multiple. The reverse can also happen. If earnings fall by half and the valuation multiple is also cut in half, the company's market value falls to 1/4 of its original level. That is why boxes 6, 8, and 9 are clearly unfavorable. A lower valuation, falling earnings, or both at the same time will reduce the company's market value. Now we reach the more important question. Which source of return am I trying to capture? In other words, where in this chart do I intend to build a repeatable investment approach? This framework classifies investors according to the primary source of return they depend on. Real investors may combine several methods, but broadly speaking, market participants can be divided into 3 groups and 5 investor types. The first type consists of investors without a clear process. They actively choose individual stocks but cannot clearly explain why their approach should work or where their expected return is supposed to come from. They may act on stock tips from friends, market gurus, financial influencers, television commentators, brokerage analysts, or the financial press. They may also trade entirely on instinct. Their results are largely left to chance. They spend the money, pass the time, and move on. Long-term index investors do not belong in this category. Holding a broad market index fund can be a clear, rational, and disciplined investment strategy. This category refers specifically to people who actively select stocks, but cannot explain why they are buying them or what must happen for the investment to succeed. The second group tries to profit mainly from changes in valuation. Some investors hold stocks for only a few days or months. Over such short periods, they generally do not expect a company's earnings to change very much. Others believe future earnings are too difficult to predict, so they focus mainly on how the market will value the business. Their ideal position is box 4. Net income remains roughly unchanged, while the price-to-earnings multiple rises. Among active investors and traders, this is an extremely common route. It can be divided into 2 approaches. The first is valuation reversion. These investors look for stocks trading below or far below the valuation of the wider market. They may also look for companies trading well below their own historical valuation ranges. They expect the valuation to return to a more normal level. Their return comes primarily from that normalization. Deep value approaches associated with Benjamin Graham, Walter Schloss, and John Templeton largely fall into this category. So do some strategies that adjust exposure to an index or exchange-traded fund according to its overall valuation. Cigar butt investing is one well-known branch of this approach. The method rests mainly on three things: undervaluation, diversification, and common sense. These investors do not expect every position to succeed. They accept that some investments will fail, while the overall portfolio benefits from valuation reversion across a diversified group of holdings. The second approach is market repricing. These investors are less concerned with whether the current valuation is objectively low or high. They believe the market will assign a higher price or valuation in the future, and they seek to profit from that chain. Technical analysis, trend following, reversal trading, momentum strategies, thematic investing, policy trades, macro trading, and some quantitative strategies may fall into this category. Within this framework, they belong here only when the expected return comes mainly from a change in market pricing, rather than from a change in the company's underlying earnings. Quantitative investing itself is simply a method of research and execution. A quantitative value strategy may be closer to valuation reversion. A quantitative momentum or trend strategy may be closer to market repricing. Large investment firms, hedge funds, portfolio managers, professional analysts, financial media, online creators, and individual investors all devote enormous amounts of time, capital, and energy to questions such as: what will the market chase next? Where will capital flow? And how much will other investors be willing to pay in the future? Some participants conduct serious institutional research. Some rely on sophisticated models and disciplined trading systems. Others borrow someone else's conclusions, copy publicly disclosed portfolios, or follow whatever trade is currently popular. This is the most visible, crowded, and seductive part of the market. It offers rapid feedback. It constantly produces stories about perfect timing, fast fortunes, and investors who discovered the next winning stock before everyone else. The winners are easy to see. The failures usually disappear from public view. This part of the market also produces the most visible personalities, the largest audiences, and the strongest commercial incentives. It appeals directly to several powerful human desires: the desire to make money quickly, the desire to predict the future, the desire to catch the next major trend, and the desire to prove that we are smarter than the market. For that reason, there will always be people searching here for quick returns, public recognition, or both. The third group focuses primarily on changes in a company's earnings. It can also be divided into two approaches. The first is the compounder approach. This approach sits at the center of Warren Buffett's mature investment philosophy, and it is followed by many long-term value investors. These investors focus on growing alongside high-quality businesses. They expect most of their return to come from long-term growth in the company's earning power. Any increase in the valuation multiple is treated as an additional benefit. Their main targets are boxes 1 and 2. Box 2 represents rising net income with no change in the valuation multiple. Box 1 represents rising net income combined with multiple expansion. There are different styles within this approach. Some investors place greater emphasis on a low starting valuation and a wide margin of safety. Others place more weight on the company's future growth and are willing to accept a higher starting valuation. In either case, the central focus remains the business itself. These investors study the industry, the financial statements, and the competitive landscape. They try to answer questions such as: how does the company make money? Why should its profits endure? Why can competitors not easily take those profits away? How much capital must the company reinvest? And how long can it continue to grow? This is a difficult path. A strong business must first be identified correctly. Its future earning power must then be estimated with reasonable accuracy. Management must allocate capital intelligently, and the investor must still avoid paying a price that already assumes too much future success. Even an excellent business can become a poor investment when the starting valuation is too high. The second approach is turnarounds and special situations. These investors expect a company's earnings to change fundamentally. They seek returns from restructurings, industry recoveries, operational turnarounds, asset sales, corporate separations, or other special events. This approach often requires deep industry expertise, event-specific research, and information advantages that most individual investors do not have. It is a specialized field, so we will not explore it further here. These 5 approaches summarize the market participants in this framework. The ranking that follows is a matter of judgment, not a statistical finding. Different people have different abilities, resources, information, and market environments. In terms of the probability of long-term success, this framework places valuation reversion first. The compounder approach comes next. It is followed by turnarounds and special situations, then market repricing, and finally investing without a clear process. From the least demanding to the most difficult to master, the order is different. It begins with investing without a clear process. Then come turnarounds and special situations, valuation reversion, the compounder approach, and finally market repricing. The exact order matters less than the central conclusion. Valuation reversion and the compounder approach have produced many of the most durable and repeatable long-term investment records. So which path should you choose? That is a question every investor should spend serious time answering. Examine your interests, your strengths, and your weaknesses. Think carefully about where you are willing to invest years of effort. Then ask where you may be able to build a genuine advantage over other market participants. The final question is, what can I rely on to survive in this market over the long term? If you do not want to spend your investing life as someone else's source of profit, you need a serious answer to that question. It matters far more than any list of hot stocks. My choice is the compounder approach.